Iran has publicly declared that it controls the Strait of Hormuz, a statement with massive economic implications. Before we go into numbers and markets, let's agree on one thing. It's not sensationalism. It is geopolitics meeting economics in real time, and it's already affecting supply chains, commodity prices, and risk perceptions worldwide. The Strait of Hormuz is now only about 33 kilometers and the most constructed point, but it carries about 20% of the world's oil exports. That's one of out every 5 barrels of oil produced. That's not small. That is foundations. Let's start with what Iran actually said. According to Iranian military officials, the country has complete control of the Strait of Hormuz. They described this control as coming from naval force, missiles batteries, drones capacities, and strategic places military units. Now, one important nuance here. Control on paper is not the same as uninterrupted commercial traffic. International shipping data shows that transit through the strait has dropped significantly recently due to security concerns and attacks. But Iran's message is clear. It's signaling its strategic position. This isn't a braiding exercise. It's a declaration with economic consequences. To understand why, we need to step back and recall one key fact. The Strait of Hormuz connects the Persian Gulf and the Gulf of Oman and the Indian Ocean. It is the gateway for oil from Saudi Arabia to UAE, Kuwait, Iraq, Qatar, and Iran itself. Closing, disrupting, or even threatening, this will affect global energy markets instantly. So let's talk oil. Since the start of regional tensions, oil prices have already climbed, reacting to uncertainty. Brent crude recently moved above key psychological level. That's not just chart chatter. That has real effects on consumers. Fuel prices at the pump, inflation rates in developed countries, production costs in transportations and logistics. It all moves together. And it all starts with that narrow stretch of water. Now let's separate real control from rhetorical control. Iran claims control, but multiplies navies, including the US Fifth Fleet, operating in the region as well. Full cycle closure remains extremely difficult to sustain. Long-term closure would hurt Iran as much as it hurts global markets, because Iran itself depends on hormones for exportations, products, and imported goods. Iran signing leverage. Leverage is the case means disruption potential, not a literal stoppage, and markets react to potentials more than reality. Commodity traders price risk before it materializes. That's how future markets work. Think of like insurance. We price the possibility of rain before a storm reaction hits. Next, energy prices don't only affect drivers. They affect industry across the board. Cement productions, chemicals, fertilizers, air travel, shipping costs. Every sector of energy input sees cost pressure. When prices rise, inflation climbs. Central banks watch inflation with laser focus. They adjust interest rates accordingly. That's unpackaged by economists as a monetary policy response. Higher interest rates mean higher borrowing costs. That slows investment. That delays expansions. That reshapes economic forecasts. Informal note, oil price shocks are like economic tremors, not earthquakes, but they radiate outward. Let's move to shipping logistics. Disruptions in hormones have already started thousands of vessels. Ocean freight is not just oil, it's pharmaceuticals, electronics, foodstuffs, and auto components. Air cargo is also affected. Complication global supply chains. When shipping routes becomes risky, insurance costs rise, and higher insurance costs get passed on. That's not mysterious. That's business accounting. Now let's talk about insurance. In response to the risks, the US has proposed political risk insurance to help maritime trade flowing. That is an example of economic policy reacting to instability. It's not a guarantee of calm, but it does reduce outright abandonment of trade lanes. Informal observation. Insurance is like a seat belt, not a shield, but it helps. We also see military escorts being discussed. That directly ties military postures to economic stability of efforts. And that's where geopolitics meets market psychology. People care more about trade stability than theaters of war. That's business reality. Now let's look at regional dynamics. Gulf Cooperation Council countries have significant stakes in keeping Oman's open. Saudi Arabia, the UAE, and Qatar can afford prolonged closure. That's why diplomatic pressures persist even amid hostilities. Think about that for a second. Everyone in the region, even rivals, depend on that narrow passage. That mutual dependence creates a natural stabilizing force. Markets call this systemic interdependence, and systemic interdependence means that while Iran's claim carries weight, the economic cost of holding power too long is high. No country wants to begin bridges with China, India, or Europe. Those countries import huge portions of their energy through Hormuz. Fuel costs increase filter directly into consumers' price index in Asia and Europe. If oil prices remain elevated, especially above certain thresholds, inflation becomes persistent. Central banks then face a harder choice between supporting growth and fighting inflation. That is a real economic policy dilemma. Now let's look how markets have reacted. In recent sessions, global stocks markets have shown volatility. Oil and gas ETFs outperformed defensive sectors. Industrial metals lagged behind. Consumer staples held value. And why? Because investors hedge risk similar to insurers. They reposition capital into less risky assets. That's not pessimism. That is strategy. Informal note. Markets are like the seasoned sailors. They adjust sails before the storm. Now let's consider inflation expectation. When energy prices rise, inflation expectations rise faster. That's because energy is direct input into most consumers' baskets. Energy influences transportation. Transportation influences food price. Food prices influence consumer sentiment. And consumer sentiment drives spending. Spending drives GDP growth. The chain's reaction is textbook microeconomics, not conspiracy theory. Next, the currency effect. Higher oil price often influence exchange rates. Commodity currencies can strengthen. Import-dependent currencies may weaken. Emerging markets feel this more that can widen current account deficit and fiscal pressures intensify in countries without diversified energy portfolios. Now let's address trade policy consequences. When a major trade artery appears, threatening countries accelerate diversification of sources. That means investing in alternative routes, building strategic reserves, and negotiating alternative energy partnerships. Now let's talk about long-term incentives. Disruptions on hormones could accelerate investments in renewables, not because traders prefer it, but because policymakers don't want future supply shocks. That is structural economic shift. It doesn't happen overnight, but it does happen when risk becomes visible. In farm observation, markets have short memories but long memories for price. Now let's zoom out and consider market stability. The global economy remains resilient. Trade flows strives to adapt. Alternative routes becomes attractive. For example, pipelines to Europe. LNG carries may railroads to safer corridors. That's not disaster. That's adjustment. Systems recalibrate bases on risk pricing. Investors allocate capital bases on new information. Corporations restructure supply chains. Governments diversify energy sources. Consumers adapt consumption patterns. None of this is fantasy. It's grounded economic response. Iran's claims of control formers is a signal, not a evasive economic blockade. But it risks factors that markets cannot ignore, and markets respond to risk fast. They price in scenarios, they hedge exposures, they diversify holdings. That is economic adaptations at work. Informal note, think of markets as barometers. They don't predict storms, but they detect pressure changes. And right now, the pressure is high. Yet high pressure is not collapse, it's a volatility with direction. Let's talk about inflation. If only energy prices rise moderately, inflation may remain manageable. If the strait remains disrupted longer, price spikes could become persistent. Central banks would then face real trade-off in policy, but they've dealt with shocks before. Remember the 1970s oil crisis. That was a structural shock that reshaped policy for decades, but it also drove innovations in efficiency. The story shows adaptively, not rigidly, wins in economy. Now consider geopolitical pushback. China has been pushing Iran to keep Hormuz open because disruptions hurt China too. Asia relies heavily on Gulf energy. That's a stabilizing factor because even antagonists share economic incentives. Diplomacy exists even amid conflict. Economics does not wait for war to end. It keeps moving, adjusting, adapting. Informal note, the world economy is like an ecosystem. Pressure in one place creates growth in another. So what's the big picture? Iran's claims about harmonious is serious. It is strategic, but it's not reversible. It's not permanent economy blockade. It is a risk event, and risk events are priced into markets constantly. Supply chains restructure, capital reallocates, governments diversify partners, energy strategies evolve. Economic resilience is built on this adaptability. Turbulence does not equal collapse. It is equals response, and response creates trajectories. Some growth, some recalibrations, some innovation, and ultimately a world that keeps moving economy. That's not optimism, that's informal economic realism. So tell me, what do you think about it?